Welcome to the big show. It's the Retire Young radio show. If you're a first time listener, thanks for stopping by. I am your host, Joshua David, and we are happy to have you with us today. As always, I have my great friend, my great pal, and I got to ask you, Al, this one question.
Uh-oh.
There's a lot of opportunity in 2021. It's close to Christmas.
Yeah, it
have
is.
you been naughty or have you been nice?
I've been pretty nice.
Are you
Well,
sure?
It depends on what you consider naughty and nice, I guess. I'm going to go with my own definition, and in that case, I've been pretty nice.
Hey, it's your lie. You tell it how you want. How you doing
I
today,
just
Al?
did.
How you doing today?
I'm doing great. How about you, Josh?
I'm doing really good. It's always great to be back, helping our Retire Young family make those better investing decisions. And we always have a jam-packed show, and it's the week before Christmas. And the stock markets were all up once again.
Mm-hmm.
Another good thing for investors: gold was up, but the U.S. dollar was down pretty big this week, which could bring some concerns to a lot of people. Now, with the stock market being kind of inversely correlated, there's some opportunities there that we're seeing more and more people want to take advantage of. And if you think that you're going to get a lump of coal in your stocking this year, well, there's things that you there's things you might be able to do, I guess, maybe to swing that around, turn that around, and maybe get some presents in there. Do you want to get a lump of coal in your accounts? And that's where we're going to talk about here today, is how to help people not get that lump of coal in their accounts, how they can potentially make better decisions in their income accounts and the retirement accounts. Before we do that, Al, let's recap the market. What's happening?
Well, again, the markets were all up. The Dow, the NASDAQ, the S&P 500 for the week, they were up. Friday was a crazy day. There were a couple things that happened that may never happen again. We had a combination of quadruple witching, where we had the options on indexes and equities and futures on indexes and equities expire. That causes a lot of volatility on its own. But then we had the largest rebalancing of the S&P 500 in history. Tesla was added. So on Monday, the S&P will start trading with Tesla and without some other assets. 130 million shares of Tesla had to be purchased at the market close on Friday. You want to look at something interesting, pull up a chart of the S&P 500. Look at the spider, for example. SPY is the symbol, or the NASDAQ, QQQ. Pull up a chart and look at what happened just in the last few minutes of the market. It was just crazy. And that's volatility that, we're not going to see that every day, but volatility is going to be here. It's going to remain until we have less uncertainty about the COVID issue, the stimulus issue, and we get into a more stable economic growth mode. So opportunities are going to be there. And we talk about this all the time. The market is always going to provide opportunities, which is a great thing for us, but you need to be prepared to take advantage of that opportunity. And that comes from education, the proper education, the knowledge of how the markets function and how you can take advantage of them. We talk about financial illiteracy. Our goal as financial educators is to turn that around so people are more financially literate. And how you do that, number one, is to have the knowledge and the skills to use the knowledge. But that's proper knowledge, not knowledge based on what causes prices to change. Because the two things that are really important are to identify when the price of something is going to change and then how far it's going to go. That's the profit potential. That should all be part of proper education, which should include a number of things: a plan, a proper plan, support, community support and mentoring, a specialist to help guide you and give you support, and then just ongoing unlimited education.
Yeah, that's important. I mean, you mentioned, a plan. A lot of traders, investors don't really have a plan. I was just talking to some people this morning, and they don't feel that they weren't confident going into retirement. So they wanted to learn new skills and techniques to hopefully give them a boost and have more confidence going into retirement and be more comfortable. But it does come down to having that proper education. You want to have more, I guess you want to, as Al was talking about, you want to be financially literate. Al, coming up next, we want to get into the accumulation phase. A lot of our listeners are in that accumulation phase and want to build for retirement. So we're going to talk about how the smart money is using the markets to create income in their accumulation accounts. Al, as we get into this next topic, I mentioned earlier that a lot of our listeners are probably in that accumulation phase. They are looking to continue to build for their retirement, right? So they're not retired, or they're preparing for it, let's say. Now, there's a lot of things that the institutions are utilizing to do that. The stock market's a phenomenal place to to build that. But there's also other markets that the institutions are using, or the banks, they're using these other assets to create that income. So I want to get into those different assets, but before we do that, I want you to explain how the market really works and why the institutions really rule this market, and how us as average investors can potentially trade like them.
Okay, a lot of things you just brought up
Let's
there,
hit them.
but let's go at them. Starting out with the phases you talked about. People, if you're still working, if you're not retired, you're in an accumulation phase. You're gathering assets that help you to survive now, but also hopefully some additional assets that you can utilize to grow a wealth bucket, a retirement bucket, because you are going to be faced with maybe 20, 30, possibly 40 years after you retire, and you need something to help get through that time period. In the accumulation phase, the way that you can invest and trade may be different than the way you invest and trade for your retirement and for your wealth bucket. But Wall Street kind of almost forgets about the accumulation phase and puts people into something that really is more long term. That's really not what they're doing with their assets. What the goal should be, regardless of whether you are looking at this on a more short term basis or long term, is twofold. Number one, to identify something that gives you a high probability of succeeding, a high probability of the trade or investment going in your direction, not the other direction, and then also a high profit potential. Those are the two key things. In order to do that, the most important thing is price. The price that you get into or out of something doesn't really make any difference what the company is, what the company does, what the fundamentals are, because there's something other than those things, other than the news that's out there and the fundamentals, that causes price to change. And that's the difference between supply and demand, the difference between buyers and sellers. If more buyers buy a particular asset, the price will go up. If more sellers sell it, price will go down. So in order to find those trades, those investments that have the high probability of going in your favor with a high profit potential, the best way to find those is at or near the turn in price. What causes price to turn, what causes price to move one direction or another is institutional activity. Big players, big movement. I asked you, or mentioned earlier, if you want to look at the charts of the S&P 500 or the NASDAQ or Tesla on Friday, look at the volume and look at what happened when that volume came into the market. It just drove the prices like a rocket heading towards the moon. Well, that's big institutional activity. The institutions had to buy 130 million shares of Tesla. That caused a lot of demand for that particular stock. So you can see that that's a good example of how demand really impacts the price of something. So the key then is to be able to identify that on a price chart, regardless of whether you are short-term trading for, the accumulation of assets now, or for long-term. It's that same basic strategy. That's kind of the timing part of it. And then the real key is to identify the right asset to use. That's what the institutions are doing. They are not using the same thing that they are putting you into.
Yeah, I'm glad you shed some light on that, as far as where to identify turns and points in price. A lot of people think that they need to go look at a company's earnings or stock price trending higher, just good things happening with the company. It's all based off, as Al's talking about, a price chart, and that's where you identify those low risk, high reward, high probability entry points into these financial markets. And you want to do that with a proper plan and the proper strategy. Al, as you kind of ended a couple minutes ago, you mentioned you want to be in the proper assets. Now, a lot of our listeners don't really know what we're talking about when we say assets. And that could be a relative term,
Sure.
right? So, what are these proper assets that us as retail investors, the public, what are those that we can utilize? Because I'm pretty sure these institutions are using them.
Well, first of all, the assets that most people are familiar with would be stock and mutual funds, maybe annuities, but annuities just are really mutual funds and an insurance product combined. But those are the assets that Wall Street puts their clients into. But Wall Street's not doing that. I can guarantee you that the big firms, the smart money, are not buying annuities that they're relying on.
They're selling them.
They're selling them. They're not buying and relying on mutual funds. Stock, that's certainly we want you to understand that when we talk about these different assets, and we're talking about things like the futures market, the foreign exchange market, the options market, that may be those are choices that you have access to in addition to stock. And we're not saying that you shouldn't trade stock. Stock is a great asset to trade, especially for long term. But some people trade stock short term. Some people day trade, and that's fine. The strategy that you're going to use to identify when to get in and when to get out is the same for our students. Our core strategy, regardless of what you're trading and what the time frame is. But most of the big players out there, the smart money, are relying on things that give them some big advantages. Stock actually being probably the least beneficial. The other ones that we're talking about that have the benefits are leveraged assets like the futures market, the foreign exchange market, the options market. And a lot of people listening don't know anything about them, or if they know anything at all, it's, yeah, I know somebody who lost a lot of money trading those. It's because they didn't know what they were doing. They didn't have the knowledge or the education.
That can happen with stocks too.
Well, absolutely, absolutely, and unfortunately, a lot of people are in this investing mode where they're just basically throwing money at something and hoping that it works out. That's not how you want to do this. You want to do it by putting odds in your favor, the probability that the movement of that particular asset is going to go in your direction, the direction you want it to go, not against you. And there's got to be a profit potential there worth putting that investment together for. Unfortunately, most people are put into something where price is not considered. It's just let's get your money in the market. It's money in the market, time in the market that's important. We don't care about profit. We're not going to be concerned about having some kind of protection because the market always comes back. Doesn't make any difference if we go through a 10% correction, a 50% bear market. At some point in time, your assets are going to come back up to where you were before.
That's a crazy comment, Al. A lot of people are listening and probably thinking, am I required to lose in down markets?
Yeah. Well, and a lot of people actually come into our workshops, Josh, and our classes and say, yeah, we did the right thing. We held on through that bear market, and now we're back to where we were 10 years ago or 15 years ago. What's the problem there? Well, that's 10 or 15 years of wasted time for you just to get back to where you were before any profit can be made. You don't have to ride a market down. You probably are if you're in a long-term buy and hold strategy or if you're in mutual funds, but you don't have to do that. There are strategies that can be used that will benefit you in a down market. There are strategies that will benefit you in a sideways market as well as an up market. But do you know what they are? Do you know the 3 or 4 ways of making money in a down market? Most people can't answer that question, but those are the things that we talk about in these classes. Josh, you have a young boy.
I do.
Child. How old is Jameson now?
He's almost 4.
Does he ride a bike? Can
He
ride a
does,
bike?
yeah.
Okay, but here's the thing. I saw this. I read this the other day. I thought it really was appropriate. You can't teach a child to ride a bike at a seminar.
That's true.
No, right? And the same thing is true with trading and investing. A lot of people will go to a seminar, listen to a webinar, and think they have everything they need to know. That's so far from the truth. There's knowledge is out there. There's a lot of details out there you can learn, but the real key is having the skill to use that knowledge properly at the proper time. And then also, which asset do you use that is beneficial to you? Maybe for you it is equity stock. Maybe it's futures. Maybe it's the foreign exchange market or the options market. But you need to get proper education in all of those assets before you decide to try to invest in them.
Yeah, I'm glad you mentioned that. I mean, these investing classes that we do, they're bringing more so some of the knowledge and then the ability to see what's out there, what's the potential, what are some of the opportunities. Then you have to build the skill, right? And anything you do, learn riding a bike, that's a skill you build.
Sure.
You get up on the bike, you may fall the first time, but you get up on, you keep getting up.
Sure.
Once you do that, I mean, you see kids driving around. I see it around in my neighborhood. Like, no hands, no eyes,
Sure.
eyes closed, all that stuff. But the hardest thing for some people is to get started.
Correct.
If you don't get started, you're never going to learn. If you feel like you're missing out on, all right, Al. So we have a topic that everybody is talking about everywhere. You see it on TV. Everybody's working towards that promised land, and that's retirement.
Mm-hmm.
There's a downfall. A lot of people are just not getting there with confidence, and they're retiring without that confidence, but they're not comfortable because they don't have enough. We have a retirement crisis. Now, there is different techniques and strategies that the institutions are putting the public in that they're doing. But the public, the retail investor, is conditioned to just let it happen. I was actually having a conversation. It was just yesterday with a good friend, and we were talking about. I mean, he had a pension plan. He was asking, "Was that good?" You know, and he's investing in in this other plan that his company offers. And he's like, "Yeah, we're told just to not to look at it. Don't worry about it. Just just put money in there and just
Right.
hope we have enough for retirement." I said, this is your hard-earned money. Why are you just putting something in an account and closing your eyes and hoping something will, hoping you can get there?
Right.
No, but that's what we're trained. That's what the public is trained. That's what employers are really telling their employees: just put money into a 401k and hopefully you'll have enough. But the facts are out there. People can't retire. What are some different things that we can do as average investors to have more confidence going into retirement?
Yeah, it is really kind of perplexing almost that we have been conditioned the way we have been by Wall Street just to go ahead with that buy and hold long term hands off strategy, and with the thought of we're going to be just fine when we retire. And as you mentioned, the reality is not that that is the case. Now there are a lot of people that have seen their 401ks or 403bs, whatever your employer sponsored retirement plan is, go up in the last year, and that's fantastic. Now, a lot of people also saw that in between 2003 and 2007. They saw their accounts go up and they were feeling pretty good. And then 2008 came, and a lot of them lost 40 to 60% of what they had because they weren't prepared. We don't know when a bear market is going to hit like that, but we do know we're going to have corrections. On average, we have a 10% correction or 10% or more correction every 11 months. This last year, we've had several. Over the last couple of years, we've had several every year. And every time that happens, your portfolio has to work harder just to get back to where it was. An example would be if you lost 50% of your portfolio's value, it has to go up 100% to get back to where you were. Whatever the percent downturn is, you have to have a higher percent upturn to get back to where you were before. So just holding on through these corrections in bear markets really doesn't make sense if there's a way that you can protect yourself or participate beneficially in a down market. Protection, when you retire, that protection is the number one thing that you want to make sure that you understand and that you have in place. Maybe it's an insurance policy on your portfolio. Maybe it's the ability to understand when you have a profit. Maybe you should take that profit.
Al, I kicked off the show and I asked if you were naughty or you were nice in 2020, and I'm going to be a little bit naughty right now.
Whoa.
I might say a naughty word. I'm going to ask you.
Cover your ears, folks.
Cover your ears. I want to ask you a question here. Do you think mutual funds, that's that naughty word, do you think, I mean, that's what everybody's putting in their 401ks is mutual funds. Do they perform like the market?
They do not perform like the market. And regardless of what they are intended to mimic, whatever the index or the sector is, they underperform. And over the course of time, if you look at 10, 15-year periods, 90 some percent of the mutual funds underperform. But that's what you are, really encouraged to put your money in. Those are the primary choices in a retirement account. Again, that's not what Wall Street's putting their money in. They're putting you into something different. But mutual funds have basically mediocre returns. One of the problems are the fees that are charged. The fees can have a huge impact on the amount of money you can have in retirement. And you think about it, you're working maybe 20, 30 years to put some money aside for retirement, and somebody's taking a chunk of that without really giving you any advice or guidance. And then also you are subject to market drawdown. So maybe you get 3 to 5% on the upside. Maybe that's kind of an average return with the potential of having maybe a 50% or more drawdown. That's not a good risk reward ratio.
All right. Now that we've upset all of our listeners, there is a light side to this story.
Oh, it's a big light.
Because that's the downfall. And hopefully some of the things we talk about here today, we open your eyes up to what's actually happening to you, what's happening to your accounts, what's happening to your retirement accounts, why the average investor just doesn't do the same as Wall Street and Wall Street's accounts. So, Al, we brought the bad things about it to light, I guess, on 401ks, retirement accounts that are being managed. And now, just to clarify, the 401k is a good thing. It's taught people how to save. The problem is the products that are being sold. Now, you mentioned something about the fees. Mutual funds have a abnormally high fee. I mean, there's a lot of fees that come along with mutual funds. What are some ways, potentially, maybe you self-direct retirement accounts? Is there any other ways that you can potentially lower fees?
Well, yeah, and really that's kind of what the Online Trading Academy excels at is helping people to get their arms around their own assets, manage their own assets, and eliminate fees. You can set up a self-directed retirement account, and there are no fees involved. So maybe 2 to 5% that could be taken away from you, which is the case in your 401k, 403b. If you can eliminate that, you have the potential to grow those accounts at a much greater rate. And you also have the potential to have protection on it. You can trade more than mutual funds or stock in a self directed IRA. You have access to the futures market, the foreign exchange market, the options market. And the great thing about those, well, there's a number of things. One is that you can use them in up markets and you can use them in down markets. Another is the leverage. And that's one of the reasons that the big players, the smart money, uses it because they want to maximize the value of every investment dollar they have. A lot of people can't participate in a large valued investment because they just don't have the money to do that. Leverage gives you the opportunity to participate in a bigger investment with a smaller upfront amount of money. It's sort of like a down payment on something. So it allows people with smaller account sizes to participate. It allows people that have a lot of money in retirement that don't want to take all big chunks of it to invest. It allows them to take a smaller amount and also have the opportunity for larger returns.
And the key is to keep that other side protected. That's the key.
Well, protection is huge. And how do you provide protection? One is to use an option strategy that basically is the same thing as an insurance policy. So that insurance policy option strategy will go up in value as your portfolio or individual assets go down. And the other is to use stop losses. Why can't you use a stop loss on a mutual fund? You can't. There's a couple of reasons. One is that the mutual funds have so many different stocks in them that it's almost impossible just at every second to identify what the total value, the net asset value is. So you can only buy or sell a mutual fund after the market is closed when they do the figuring to figure out what the net asset value is. The other reason is that if you have the ability to have a stop loss, which will get you out of the market if that mutual fund happens to go down, Wall Street doesn't want you to do that. They don't want you to take your money out of the market because then their fees are gone.
Al, I ended that last segment. We want to continue this discussion about trading and investing, but there's a lot of listeners that are probably working and they work during the day and they're thinking, well, hey, I can't participate in these financial markets because I work during stock market hours. Now, we did talk about the futures and the Forex market, how they are 24 hours a day, which means they're open around the clock, so you can participate in the evening. But I want to talk about something called target trading. So say somebody that wants to participate in the stock market and is working during the day. Is there a way to set your trades up, have targets on them, where the computer will execute that for you?
Yeah, absolutely. We have really received some great benefits over time here in our ability to be able to trade and invest, really almost giving us advantages over the big players. The trading platforms are very sophisticated. We've got the high-speed internet. And what you're talking about when you're talking about targeting, we talk again about the right price, having the right entry price or exit price. That's the first target. So in your trading platform, you can set that target, set the point, the price at which you want to enter a trade. Let's say you're going long. So you set the price at which you want to enter the trade. And then you also have to target the profit potential and identify a trade that has a great enough profit potential for you to put the trade together.
Basically where you collect your profits.
That's where you're collecting your profits. And then also target the wrong movement. If you're wrong, and you're going to be wrong, no one is going to be 100% right, but you manage that. So you have a target at which you are out of a trade, which keeps a loss a small loss. And the great thing about a small loss, Josh, is it can never be a big loss.
You're correct.
So those are the three targets that you tell your trading platform, you identify those, and then you don't have to be there. The trading software will do the work for you.
You're exactly right. You have to have that proper strategy though. So when you place your targets, and then you have that strategy as I was talking about, the computer will execute it
Right.
for you is what you're saying, right?
Yeah, and
So
the quality of those the quality of the profit target, the quality of the we're going to call it stop loss target, that's based on the proper price, the entry price or the exit price. That's the most important thing, is to identify that. That's where the timing comes in, because that's going to show you where the institutional activity is going to take place.
yeah, we covered that in the first segment about where to get in, but also where to also get out. And when you do that and have a strategy, you have the lowest risk, and that's what what we teach is have the low risk, high reward, high probability entry points into these markets. Now, Al, we have thousands of listeners on this show every single week, and a lot of them are brand new to the markets, have
Mhm.
have never traded, they don't have retirement accounts, and they want to learn the skills and knowledge to get started with that. We also have several people that are trading, but are looking to gain an edge. We talk about how to gain an
Right.
edge every single week. We also have, and I think this is the majority of the listeners, is they have retirement accounts or 401ks, IRAs, whatever that may be, 403bs. So they're technically investing in the market, but they're not doing it. They're letting somebody
Mhm.
else do that. So we're seeing more people in that category that want to learn more about how to do more on their own, how to make educated decisions, better decisions in their income accounts and retirement accounts. So let's talk to all three of these investors. How do you get started, even if you have been trading, if you're brand new, or if you're just investing with retirement accounts?
Well, one of the reasons that we do these free classes that you've been talking about is so people can get an idea of whether this is something that is right for them or not. And we always identify people that we will tell, this may not be the right thing for you. Maybe it's not in your benefit to try to control your own assets. But this is a great way to start, to learn whether it is right or not, and then put together an education path from there. But yeah, for a lot of people, we talk about these retirement accounts that people have. For a lot of people, it really is more like just a storage facility for their money. Their money is taken out of every paycheck. It's put into something, and then basically people just forget about it and just let it ride. It's not a one size fits all kind of a thing. That's not the way that you benefit from what the market is providing for you. And when we teach, there's some things that we think are very important. I mentioned the child. You can't teach a child to ride a bike at a seminar. The same thing is we feel is true with investors or traders. You need more than that, and this is kind of our components. We tell you, we show you, and then we let you do it. You have to get hands on. You have to actually trade and invest to learn how to trade and invest. But it's not something you want to do on your own, because you're going to make mistakes that could be very costly to you. Do that under the guidance of somebody who has done this on a regular basis, who understands the markets, who can help guide you, tell you, yeah, you're doing that right, or no, you're not doing that right. Let's just make a change here and see if that works. That's kind of like having training wheels on your bike. That's what we do during the classes. But then when you take the training wheels off, I remember with my kids, I had to run on the side of the bike, hoping that in case they started to wobble a bit, I could grab them. Well, the same thing is true with our teaching. We kind of have somebody running alongside of you. You have access to live trading sessions where our instructors are maybe trading their own accounts, showing you what they're doing, why they're doing it. So that's kind of the ongoing education part that helps build the skills. Those are all part of proper education, but it should also provide unlimited access to education going forward, because the education never stops, Josh, and things change. You always want to make sure that you're with somebody who can guide you through those changes.
You're right. I mean, it's also about having the proper, I guess, community as well.
Yeah, absolutely.
You want to be in anything that you do. If you're going to be in a yacht club, or if you're going to be in a tennis club, you're going to be with like-minded people. So you're probably going to do things, especially in the tennis. You're going to probably practice together. You're going to probably hang out together. You're going to learn off of each other, because somebody's strengths could be your weakness, and they can help you with those weaknesses, or your strengths could be somebody else's weaknesses. So
And they
that's
can
why
help challenge you to do something that maybe is out of your comfort zone.
you're exactly right. That's why it is so important to have that community behind you, because trading and investing, you need that community. You need the community of like-minded people, different trading ideas. Let's just say you're in an investment club. There's a lot of people want to be in investment clubs, and we see a lot of people, a lot of our students that actually create their own. They come here and they meet once a week. Sometimes there's other groups that meet once a month. It's just having that camaraderie. And you mentioned an interesting, something really interesting a little bit ago. You said trading investing may not be right for everybody. And that's why I'm glad we do this show, because we really give an honest opinion on what's really happening in the markets, but if this is for you, right? So trading investing may not be for you, but you said, what if it is? What if it is for you? What if you didn't find out? Would that change your life? Probably not. But that's what we do here on the Retire Young radio show, is hopefully we can inspire people to do things that they haven't done, to learn a new skill. And really, the year is almost over. If you haven't learned a new skill in 2020, 2021 could be that year to learn that new skill. And here's that question you got to ask yourself. What if it is? Al, hit them up with some words of wisdom.
Well, you mentioned the word afraid. There are a lot of people out there that are afraid. And we know that there's only about 5% of the people in this country that are truly financially successful and secure. Do that 5%, did they have fear? Absolutely. But they search for knowledge to manage and overcome it. So if you want to make a change, you have to be able to realize that change. You have to take a chance. If the change you want is worth taking a chance, well, then learn the proper path to take, the proper education, the proper knowledge. The market's going to continue to provide opportunities. It's up to you to be prepared to take advantage of those unlimited opportunities.
That's those 3 C's. Make a change, take a chance to make better choices. Same time, same place next week. Until then, retire young, my friends.